Hello and welcome. I'm Whitney Roseborough, one of the marketing coordinators here at Squire. Thanks for joining us today for our 2020 market review. A couple of things before we get started. If you look in the Q&A section, you will see links to our upcoming webinars if you'd like to register for those, as well as a link to sign up for our monthly email newsletter, which includes the latest accounting news, updates, and more. You can also, if you have any questions throughout the presentation, please feel free to enter your questions in that chat. Now let me introduce you to our awesome presenters today. Today we have Clayton Johnson and Nathan Larson. Clayton is a certified financial planner and wealth advisor for Squire. His focus is financial planning for business owners. Outside of work, he enjoys playing and coaching volleyball and spending time in the mountains with his wife and twin daughters. Nathan is a CPA and wealth advisor for Squire. His focus is financial planning and tax. He enjoys helping his clients with all areas of finance and tax strategy. So with that, take it away, Clayton.
All right, thanks, Whitney. So I'm going to spend just a couple of minutes going over a high-level overview of the markets in 2020, and then address one question that we've been seeing from a number of our clients. So needless to say, 2020 was a unique year for all of us personally, but also in the markets. The way we interacted with businesses and the types of businesses we interacted with was totally different than times in the past. And because of that, some companies did really well and others did not and may be closing their doors permanently. If we go back almost exactly a year from today, it was on February 19th, the S&P 500 hit a record high, and then the following 5 weeks dropped almost 34%. But then from its low in March 23rd, the S&P 500 jumped almost 18% in just 3 days, which is an incredible snapback, and one of the fastest we've seen since like 1896. And when we go all the way till December 31st of 2020, most indexes, excuse me, actually ended positively for the year. And this wasn't just unique to the US markets, this happened all over the globe. We saw pretty great performance in international markets, emerging markets. Yet, we still see economic news that seems to be painting a grim picture, like low unemployment and slow GDP growth and high unemployment, jobless claims. And so the question that arises a lot, and we've heard a lot, is how are we hearing these grim economic news reports, but the stock markets seem to be doing so well? And the short answer is the economy and the stock markets are not the same thing. So stock prices in the markets reflect the future profits of companies. So they're reflecting the expectations about future and less about what's currently happening or what's happening in the past. Whereas economic indexes oftentimes are looking months in the past or sometimes quarters in the past. And so when you see that stock prices are going up, but the news is painting this poor economic picture, it's not because the stock market is broken, they're just measuring two different things. In fact, as I mentioned, the economic news, sorry, my mic is messing up here just a second. So economic news is backward looking, like I mentioned. And so when we focus on economic data, it's like looking in the rearview mirror to figure out what's in the road ahead. So the bottom line, what we often recommend is looking at the news as a great way to be an informed citizen, but not a great tool to navigate the financial markets. So with that, I just want to mention that I will be monitoring the Q&A. So if you have any questions, please write what you have. I'll be watching that, and then Nathan and or I can address that either then or we'll wait till the end of the presentation. But please ask whatever questions you may have. I'm going to turn the time over now to Nathan to go into a deeper dive into what happened in 2020.
Okay, thank you, Clayton, and thank you to everyone who's here today with us. We're happy to have you. We titled this presentation "Hindsight is 2020" just because it's always easy to look back and try and understand what happened and why and wish we would have made different decisions. And that's just not how life works. You can't bet on the race after it's over. And so 2020 taught us a lot of different things in all aspects of life. And specifically for what we do in financial planning and wealth management, it really taught us and reminded us more than anything that our principles should be sound when we are dealing with finances and trying to create wealth. And it's really important to have a plan in place and to stick to that plan. So I'm going to talk a little bit about what happened, just to be, just to kind of look back and see. And then we'll try and give you a few tips and tricks looking ahead. We don't try and predict what's going to happen in the short term. What we do is put together really detailed, well thought out plans for our clients that give them the best chance of meeting their goals looking forward, and then we manage those plans along the way. So if we just look at the overall broad market, you can see 2020, you would never have guessed, heading in, if you had known there was going to be a global pandemic, economies were going to shut down, crazy things were going to happen, an election year even. So you would have never predicted that the markets would have been up for the most part. And you can see here from this chart, the U.S. stock market's up over 20%. International markets in the developing countries were up almost 8%. Emerging markets were up almost 20% as well. The only down market was global real estate, which is interesting and just kind of an anomaly, but that happens. And then even the bond markets, with as interest rates as low as they are, even the bond markets did well. And a lot of the increase or the growth in the bond markets came because interest rates did go down. So when interest rates drop, the value of your existing bonds goes up because it's paying higher rates than what the market is now going to pay looking forward. So a lot of that growth happened just from the interest rate drop. Some of the growth in the bond markets happened because when the pandemic hit and we had the big market drop in March and April, there was some flight to safety. And so the value of safer assets went up. That's just kind of how it works. But if you look at this graph, we do go back 20 years. Every single one of these, except for real estate, outperformed its 20-year average, which is just crazy to think about during the year that we had, and having, in some cases more than double the 20-year average is just wild. But what this shows us is that you can't predict the future. We don't have a crystal ball, and if we did, it would be cloudy. And so when you're thinking about how you want to invest your life savings and your wealth, you should have a well thought out, diversified plan that gives you, that's based on your individual risk tolerance as an investor, and then stick with that plan and stay diversified. So I'll keep going and kind of jump into some of the details of these broader markets, and then show you a few graphs and things just to have fun here today. So here's the same averages. If you go back 10 years, the bottom line there, what's really interesting to me is the U.S. market has outperformed its average significantly over the past 10 years. The international developed market and emerging markets have underperformed their averages. So typically, because we don't know what's going to happen in the next 10 years, it would be tempting to load up on the U.S. market here, and because it's been the top performer. And that's actually counterintuitive on what you should do. Eventually what we would expect is that these international markets the averages will revert back to the mean, and we'll have some increase. We don't know when that's going to happen, and because we don't know when, the prudent thing to do is just to diversify across all of the markets and to stay rebalanced. So once we come up with strategies for clients, we'll target specific percentages of investments in each of these markets, and then as they drift, we'll rebalance. And what that does is helps us to sell low or buy low and sell high without, bringing emotion into the picture. This graph really tells a pretty cool story for 2020. This is a global index, so an index of global stocks, and down at the bottom we have various headlines throughout the year. And this just tracks what happened. You can see, we have at first the market starts out the year doing well. The virus, the coronavirus is discovered in China, but it's, we're not really sure what's going on, and the market doesn't care about it to begin with. And we get going here, and then the market starts to really figure out, hey, this is going to have an impact on things. And we have this huge drop, the fastest drop that we've ever had in the stock market. And on top of that, oil prices go crazy low because Saudi Arabia decides to increase its production in oil during a time when the demand for oil is way low because nobody's traveling due to the pandemic, and nobody's really even driving very much. And so the demand for oil goes down and the supply goes way up. And so we have kind of this double whammy happening here. And then you can see some various headlines throughout, and the market snaps back very quickly, and then it just kind of marches on and ends higher than it did when we started the year. Which again, I would never have predicted, had I known that there was going to be a global pandemic. And even when it happened, I was thinking, gosh, it's probably going to take a few years for the stock market to come back. And sure enough, it comes back by the end of the year. And even so far in 2021, it's doing pretty dang good. So what this picture tells me, the broad story here is, you cannot time when things happen. When the pandemic hit, there might have been some temptation to sell out of the market and go to safe, get your money in cash and get it out of the market and put it on the sideline till you think that things are better, and then put it back in. And the problem with doing that is you have to guess right twice. You have to guess when you think the lowest point is going to be, and then you have to guess when you think when it's time to get out, and then when it's time to get back in. And history has told us that nobody's been able to do that consecutively, consistently over time. Even the mutual fund managers on Wall Street that try to do this, there's been lots of studies done where the returns that they're earning compared to like even just index funds, there's not really a comparison over time. Year by year, there'll be people that say they can do it and they'll get lucky, but over time, they're not going to be persistently able to capture any gains by timing. So our philosophy and what we recommend doing is, you need time in the market, not timing is what's important. Okay, another interesting thing last year and kind of over the past few years within the individual market. So this is the U.S. stock market. The large growth companies have way outperformed everything else, and that's not normal. So it's kind of an anomaly. Typically, over time, smaller stocks and value stocks will outperform large stocks and growth stocks. That's just what history has shown us. And from an academic theoretical perspective, it makes sense because smaller companies are more risky than large ones, and value companies are more risky than growth, and risk and return are related. And so, over time, you'd expect small companies and value companies to outperform. We're in this weird period where large growth stocks have way outperformed their averages and have done really, really well. And this holds true not just in the U.S. market, but also in some of the others, which we'll get into. So same thing on international developed stocks. Value stocks actually were negative for 2020, whereas growth stocks were a little bit closer to the average, and small stocks underperformed large. Actually, small caps outperformed large, but really we had a negative value premium, which is not typical. It happens from time to time, but over a 10-year period, we would expect the value premium to show up and reward investors for being invested in value companies. Emerging markets, really similar story here. We had growth stocks way outperforming everything else, and value stocks you can see down at the bottom. Still positive performance, but way underperforming growth. So, the question might come up in people's minds, hey, is the value premium not there anymore? Or, has something changed in the world? And the answer to that would be no. Looks like I got something coming through. The prudent thing to do is to just diversify across all of the different asset classes. That's how we do it. And that diversification should be based on a well thought out plan that's specific to, your ability, willingness, and need to take risk and your specific life goals. And then once you have that plan in place, if you stick with it, you should do better than you would if you were trying to jump back and forth between asset classes or in and out of the market, or even trying to pick, specific individual stocks. This chart here is one of my favorites, because sometimes, especially over the past few years, as we see the U.S. market outperform the international market, there's some tendency for investors to think, hey, I wonder if I'm just better off investing in the U.S. market only. And the answer to that is no. Diversification is going to pay off if you allow it time to work. Because if we go back 10 years, it's true the U.S. has outperformed international. If we go back another 10 years, the international market significantly outperformed the U.S. market. And so these things kind of bounce around and go back and forth. And just in 2020, you can see here which countries, this is kind of a ranking of country markets that performance high to low. Denmark was actually the highest performing country in the developed markets, and then Korea was the highest performing country in the emerging markets. The US, if you notice, it's on the left-hand side. It's like the fifth or sixth one down. Strong performance, but it wasn't the best. And the point here is we're not trying to pick which one's the best. We want to diversify across all of these so that we capture the returns that the markets provide, regardless of timing or trying to pick which one's going to be the winner. Okay, the last thing that I'm going to talk about here, this is a cool chart that I use quite a bit in planning, and it helps to just illustrate the risk-reward trade-off. And so over on the right-hand side, we've got stock bond mixes, and then at the very bottom, we've got all 100% treasury bills. So you can see that bottom line, if you invest everything in treasury bills, which is a pretty safe investment, we would consider that to be pretty much risk-free. It's a nice smooth ride, but the growth of that investment is just not going to be there because of the risk it's risk-free, and so you're not going to have a high return on that investment. As you go up, we're kind of increasing our exposure to the stock market. So the next one up, we've got 25% invested in stocks and 75% in bonds. And the line starts to get a little jaggedy. You obviously we would expect you to earn more in something like that. It's going to be a little bit of a bumpier ride, but the reward is there, and it just gets better and better the more exposure you have to the stock market. What I think is really crazy is there's kind of three big dips here, regardless of the portfolio mix. And this is just something that investors have to be aware of. The market, has corrections on average every 7 years. There's, sometimes they come in a shorter window than 7 years, sometimes longer. So you can't really predict when they're going to happen, but about every 7 years, there's a major correction. And this first one you can see just over, it's the 2000.com bubble. Really big correction there, and then things kind of marched back. And then the next really big one is the 2008 financial crisis. And really since that point until 2020, we had the longest period of without a major market correction, and the longest period of economic expansion ever. The pandemic hit, and there was really no signs that we were going to have any issues going forward, but in the short term. But the pandemic hit, and we had that next big correction with a really, really fast recovery. And so it's just kind of interesting to see here. So 2 points on this slide. One is, the risk and reward matters, and you can see the trade-off. If you're 100% stocks, you significantly have more wealth over time than you would if you have a more conservative mix. And there's not a right or wrong here from there is for you as a unique individual investor, but not from you should be all stocks or you should be zero stocks. I mean, that's a personal individual question based on your overall willingness and ability and need to take risk. So that's what we help figure out, and then come up with plans that make sense for our clients. But again, with these corrections, when they happen, they're not fun. We just went through one. I'll have to admit it does test us all, our resolve to stick with a plan, but that ultimately is the right answer. Is when these things happen, you just have to stick with it. There are some things you can do along the way. We were harvesting losses for tax savings. We were rebalancing, which means, if you had a mix of stocks and bonds, we were selling bonds and buying stocks while they were down, and we were doing that systematically based on our plans, and that tends to pay off over time. It's really hard to do emotionally, but if you can come up with a long-term plan that's specific to your individual goals, then you can usually have a better outcome over time, because the plan is helping guide you when times are good and when times are bad. So the temptation now sometimes, after the market's done well, and it's starting out really well this year so far, is to get too aggressive or too greedy and kind of flip the other way. And that's not the right approach either. The right approach is to come up with a specific, unique plan for you as an investor, and that meets your goals. I think that's all I have from a slideshow perspective. So we'll check the questions and see what's come in. If you have a question, feel free to put it out there. Lots of things happening in the world. We're studying finance every day, and so we kind of have a good take on what's going on, and we're happy to answer any questions you might have about the economy, the stock market, investing, potential inflation risks, taxes, anything like that. So put your questions in the chat, and we'll go ahead and answer as many as we can over the next 10 to 15 minutes, and then we'll let you go and enjoy the rest of your day.
So Nathan, right now there's been no questions posted.
Okay. We'll keep watching it. All you participants out there, if you have a question, type it up. We'll try and answer it. One I'm hearing a lot of concern about is potential higher than expected, higher than normal inflation going forward because of government spending and all kinds of things like that. So, and that's a concern, right? Anytime you have the government essentially printing money, there is a concern of higher than normal inflation. And really what I would say there is, if you look at global economic pressure for inflation, it's really there's actually a lot of pressures for deflation. So, and those come from globalization, increases in technology and productive capacity. Those things all put downward pressures on inflation. And the Fed chair, Jerome Powell, has actually been trying to get inflation up, for two reasons. One, it's been historically low, and Japan's a great example. I mean, their inflation's been they've been in a deflationary period for years, and we don't want the U.S. to get in that sort of situation. And so the Fed is trying to bump inflation up a little bit closer to its historical averages of 2% or so, and so that's happening on purpose. The other reason that the Fed is doing that is because the government debt is pretty high, and that's another concern I hear a lot about is the government debt's high, or how are we ever going to be able to pay for it, and is it sustainable, all those kinds of things. And the Fed is actually keeping interest rates really low so that growth can happen at an economic level, but also so that the debt service from the federal government is low. If they can borrow money at basically zero, then the cost of borrowing the money is really low. And so you have higher inflation, back up to closer to the 2%, low interest rates. It means that the government essentially uses the inflation to kind of pay off the debt, and it doesn't pay it off in nominal dollars, but it pays it off as a percentage over time. And so those are kind of the things going on there. From an individual perspective, inflation is, investing in the stock market, you're kind of hedging your inflation risk, because if we have higher than expected inflation, it means that expected stock market returns are higher as well. So.
Hey, Nathan, we had one question come in. What effect will the stimulus spending have on portfolios?
Yeah, it's a good question. It's interesting too, because so stimulus should help the stock market and the economy. That's what it's for. They're pumping money into the economy so that people will go and spend and put it right back into the economy, and as the tide rises, all the boats go up. So that should help. But what's interesting to me is when they've done 2 rounds of stimulus, direct payment stimulus. They did it at a time when some Americans weren't able to spend it, right? I mean, if you wanted to go traveling with that money, you're not doing that, most likely. If you wanted to go out to eat with that money, you're not doing that because of the pandemic. And so there might be some pent-up demand, and I think the savings rate across all Americans is higher than it's ever been. In total, I know there's some Americans really struggling, but there's also others that have been able to work from home. They've all, their income hasn't changed much, and then you throw on this stimulus money, and it's just sitting in the bank account waiting to be spent, and so that should help as well. But it's pretty hard to pinpoint exactly what will happen there, but you'd expect it to help. And I know the government, the current political environment that we're in, they want to they want to do as much stimulus as possible and not underdo it, basically. And that the Fed agrees with that as well. So good question, but hard to really answer specifically. One thing to consider that we each have some control over, not total control, but a little bit of control over, is tax rates are historically low, from the Trump tax cuts. And they'll likely have to the government will likely have to raise taxes in the future. We don't know when, we don't know how much. Biden has already, his tax plan has already been kind of published when he was going through the election process, and he wants to raise taxes on individuals that earn more than 400,000, and then also on corporations and things like that. So there probably is some tax legislation coming down the road. Things to think about now, if you're in a lower income year in 2021 than you might be later on, maybe you can accelerate some income. There's lots of ways to do that. You can take more out of retirement accounts. If you're in the retirement phase, you can take traditional retirement money and convert it to Roth, so that you're taking it into income at a relatively low tax rate, and then going forward, that Roth account will grow tax-free forever. So there are some planning things to be thinking about from a tax perspective that might make sense, and we're happy to help there. One of the unique things about Squire Wealth Advisors is we're financial planners, but we're also CPAs for the most part, and so we have more of a tax. We're really considering how taxes impact our clients' plans and portfolios over their lifetime to keep their overall tax situation as low as we possibly can, not just in any one year, but over the lifetime, over their lifetime. And you won't find that with other advisors, at least as in depth, because we do, like I said, we are CPAs for the most part, and so we're thinking about taxes more than other advisors might be.
Hey, Nathan.
Yeah.
One other question came in.
Okay.
Are low current interest rates a concern going forward?
Yeah. Well, I wouldn't say it's a concern. It definitely makes it hard to set money in the bank. If you've got savings in the bank account and it's earning 1/10 of 1%, it's pretty hard to leave that money in there, because your purchasing power is being eaten away by inflation as that money's sitting there. Now, there are purposes for those accounts, right? And we always tell our clients you need to have an emergency fund in place. You should have at least 3 to 6 months if you're retired, or then maybe you have a year or two worth of living expenses in really safe, in a bank account or in really safe assets. So it does kind of encourage people to put money into the market, because the growth is, the potential is so much better. But from a long-term perspective, I don't think so. Interest rates will have to come up at some point, but now is not the time. I think the economy needs to be the situation in the economy needs to be improved before interest rates come up. I will say that lower interest rates does give it, looking ahead in investment returns, expected investment returns, having lower interest rates pushes expected returns on all investments down. And so that's something to think about. And we build that into the plans we run. Our expected returns looking forward are a little bit lower than they would have been maybe 10, 15, 20 years ago.
Yeah, and I'll just add one thing to that as well. The low interest rate phenomena, I'll call it, is been going on for the last several years, where we've just had historically low interest rates for a while now. And what that's done to the way we build portfolios is, 10, 20 years ago, you could get a much higher yield on your fixed income investments. And so a lot of people would look at their fixed income as like this constantly providing them livable income, where they build their portfolio and, this part is just going to sustain my living. Well, interest rates have come down so much lately that fixed income doesn't really fulfill that role. And so the way to look at a portfolio is really an overall performance perspective, and making sure you're considering the stocks and the bonds in your portfolio, because a 100% bond portfolio just likely isn't going to beat inflation. You really need to take on more risk in your portfolio to have exposure to stocks to compensate for the low interest rates that are in the market right now. Yeah,
that's a good point, Clay, and it does. if you have a conservative risk tolerance as an individual investor by nature, it's a little challenging now to build a portfolio that's going to keep your purchasing power where it is throughout your lifetime, over retirement lifetime. And the way to do it is to be willing to take a little bit of risk with that portfolio. And so maybe it's not you can still be conservative and have some stocks in there. And the bonds, they're not going to be producing very much interest income over the next few years while interest rates are low, but they do provide safety. So when we have those market corrections like we've just had, and there'll be more, it might not be because of the pandemic, it might be because of something else, and we'll have more of those. When those happen, if you're making regular withdrawals from a portfolio, then at that point you're taking your withdrawals from your fixed income that hasn't been negatively affected. It might have even gone up, like we saw in March and April. Bonds went up because people were flying to safety and interest rates went down, and so the value of bonds went up. And then so you're taking your withdrawals from bonds, and then when the market's doing well, you're taking your withdrawals from stocks, and that's called rebalancing. And so figuring out what the proper mix for you as an investor is very important, and that's what we do, and we can help kind of manage that allocation over your lifetime.
And Nathan, you'd mentioned earlier too, one of the results of low interest rates is it causes people to push more into stocks in their investments, right? Because they're trying to get a higher return on their investments. And what we're seeing within bonds on a more micro scale is that people are moving away from safer bonds into what are referred to as high yield bonds. And we would actually typically advise against that type of practice, because what happens when you get into these high yield bonds, sometimes they're called junk bonds, is you're basically purchasing these loans of companies that are less secure. And so you're incurring a significantly higher amount of risk in the bond portion of your portfolio just to eke out a little bit more return. And so our advice is, as you mentioned before, Nathan, the fixed income, the bond portion of your portfolio is that anchor. It should be the part that you consider the portion of your portfolio that's going to hold things down when the markets go crazy and they do these ups and downs like you're seeing in this chart here. We don't want to add risk into the fixed income portion of our portfolio any more than necessary. And so staying usually to higher grade bonds, ones that have a better rating as far as safety, and shorter term. Usually the shorter term of a bond, the more secure it is. And so that's always our advice, is to kind of stay in the shorter to mid-term range and not go into those junk high yield bonds, because the extra risk you're taking is often not worth the reward for those higher yield fixed income solutions.
Yeah, that's a great point, Clayton. Any other questions come in?
No.
Okay, so the last thing I'll say, sometimes I think it's good to be reminded on what you're investing in when you invest into the stock market. And I told several people this as we were going through the election process, because sometimes there's a tendency around elections to be unsure about what's going to happen in the future, and to maybe there's some temptation to change, to make decisions that might not be best to make. So when you're investing in the stock market, you are buying ownership in businesses. That's what stocks are. You become an owner of multiple businesses if you diversify multiple businesses across the global world, the global market. And those businesses are out in the marketplace trying to earn a profit, and they will figure out how to earn a profit regardless of what the political environment is, regardless of what the economic environment is. And as those businesses are out there in the marketplace earning profits, you're sharing, as an owner, you're sharing in those profits. And so that's what the investments in the stock market really represent. And so while it's difficult during an election or a pandemic or any time when things are uncertain, to think of it that way, that's really what it is. And so you're buying into businesses that have really smart people running them, that are out there scheming and planning and working in the marketplace to try and earn profits, and you'll share in those as they come. Now, there's always businesses that don't do well, and that's why we diversify. Collectively, though, the stock market, the reality is that the stock market has rewarded investors for staying in it and being patient and putting their capital at risk there. So if you have
one more question one more question came in, Nathan, if we've got time for it.
Okay.
So someone wants to know what our opinion is on cryptocurrency and having that as part of our portfolio. We've been seeing that a lot lately.
Yeah, cryptocurrency has had some crazy, it had a crazy run up, and it's happened before, but it's really a new asset, if you want to call it that. It hasn't been around that long. We don't include that in our portfolios. We have clients obviously that want to do that, and it's it's okay. I would say it's very risky and very volatile. So if you're going to do something like that, I would make sure that you have a diversified portfolio of other assets, and maybe you're putting, you're willing to set aside an amount that you could lose and still have it, still have your finances in order. So I'd be cautious there. I don't know where cryptocurrency is going. It's not backed by any government. It's not revenue producing, and so I tend to stay away from those types of investments, because if you think about it, it's just there and it's not going to produce any income. Think about gold and silver. Gold and silver are just metals. They're not out there in the marketplace like a business is, or if you own stock, remember, you're owning a business that's out there trying to make money. Gold is not trying to make money. It's just a metal. Silver, same thing. Cryptocurrency, same exact thing. It's pure speculation that if you buy into that, you're speculating that the price is going to be higher when you sell it than it was when you bought it, and there's no way to know that. I could see cryptocurrency going crazy high. I could also see it crashing pretty fast, and I don't know which it's going to be. So if you want to have a little bit of cryptocurrency, do it smartly. So set aside an amount you're willing to lose, or a very small percentage of your wealth. So that's my take on cryptocurrency.
Yeah, that's a good point, Nathan. That's when Elon Musk, recently purchased, what was it, like 1.5 billion or 1.3 billion worth of cryptocurrency, and then it got, there's all this hype that builds up around it, and a lot are comparing that hype similar to what we saw in GameStop earlier this year, where cryptocurrency doesn't really have like an underlying fundamental way to determine its value, right? Like you can with a company. And so for that very reason, I'm also very cautious and would typically recommend against it in a portfolio, other than like what you said, a small portion of your fund money, right? Some people will say, oh, I'm going to do 3% of my portfolio value, and this is just me playing and having fun. And if that just really gets you going and that's what you want to do, then that's not the worst thing you could do with your money, I guess, but typically not a great thing to put in your retirement portfolio that you're going to rely on when you stop working and you need that income for your life, sustenance, essentially.
Yep, definitely proceed with caution there. And I would, if it were me, I don't have any cryptocurrency. I don't see myself buying any. If the world starts to adopt a cryptocurrency and it gets backed by a government, then maybe we'll end up using some cryptocurrency to buy things in the future. But right now, it's pure speculation in my mind.
And one of the things that people don't often consider are the tax consequences of these things. And cryptocurrency is really weird when it comes to taxes. I mean, there are firms specially dedicated to helping you find your transactions when you have things move from one wallet to another, and making sure that it doesn't count as double transactions to the IRS. There's just a lot. And so you're taking on that added burden of, you're going to be paying more on your tax return. You're going to be spending more time trying to figure out all the tax consequences of cryptocurrency. And so consider that consequence as well of involving in all those different currencies.
Yep.
That's it for questions, Nathan. And I think we've spent about 45 minutes. So.
Thanks everyone for attending. And we do have a Social Security webinar coming up next month. I believe it's on the 17th, March 17th, where we'll talk about Social Security and some strategies around when to take it and things like that, and just really how the system works. So join us for that one, and have a great rest of the day.
Thanks, everyone. Take care.